Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is September 13th edition of Market Outlook. Well, lots of contrasting opinions about what the Fed is going to do. Is it going to raise in the face of this market volatility? Our economy is improving. That's definitely a more supportive argument for doing the raise. With the increased volatility, the question is, can the market sustain even yet more volatility? And can the central banks work in unison to stabilize the markets if, in fact, the Fed does raise? So let's get into the charts and see what exactly they're telling us and what the critical points are. Obviously, this waterfall, this is the S&P 500. You can see we are definitely in trouble. Now, there have been times that we've tested the 200-day moving average back in October of 2014, and you can see that there's a big difference. We were still trading in a scenario where the 50-day and was well above the 200. The blue line here is the 50, here's the 200. Once we regained the 200, we started moving back into a more positive phase type scenario. The situation that we have here is quite a bit different. Plus, we have this wedge-like formation playing out. So the recent lows of Thursday and Friday are critical because it is the breaking of the wedge, which could possibly result in another waterfall down move, and certainly a test of those recent lows on that crash flash back in late August. So can we rally back up to the 50-day moving average or even the 200? Absolutely. However, notice that where the 50-day moving average is sitting, it's right at a resistance level now. Remember, support, right, back in March, April, and last year as well, was around the 204 level, and that is exactly where that 50-day moving average turns in. So you can basically look at this and say a fairly sharp rally, possibly up to 204, which is, a good 9-10 points from here. That's a good 4% rally from here, would still not get this market out of a troubled scenario. On the other hand, a potential drop through the recent support level right here at around 194 would break this wedge and potentially set up a test for of the recent lows at a minimum. And again, you can see the spike in volume here and relatively weak volume. In fact, no true accumulation days have occurred in quite some time. So we've been in a clear distribution, right? That's where distribution days is where volume exceeds the prior day's volume on a down day. Accumulation day is where up volume, the volume on that day exceeds the prior day's volume on an up day. And a true accumulation day is where it's also exceeding the average volume over the last 50 days. And as you can see, we've had 0 accumulation days. Now, that's an interesting point. Obviously, the big players are still distributing stock here as well. Let's take a look at some of the other indices. QQQ, which is doing a bit better. That is still the leading index, and you can see even with the Qs, which is doing a bit better, it's even marginally up about 1% on the year, is sitting under the 200-day moving average. Now, we haven't broken into a death cross, so the best play right now, the strongest stock index is the QQQs. That's the NASDAQ 100. That is the leading index. Now, of course, you also still have a wedge formation playing out. So you do want to see this hold the recent lows of the last 3 to 4 days. That's critical. If we can't, we've then created a test, a back test of the 200, and then a potential failure. Obviously, a move above the 200-day moving average would definitely give us a pause about the overall bearish scenario in the markets. And let's watch that as well. That comes in around the 107 level right here. All right, so let's take a look at some of the market internals. As you can see, the McClellan oscillator, which here is in the middle, actually is sort of in the middle of its trading range and is still working off the oversold condition after that panic sell-off back in August. So sort of gathering a little bit of steam here to the upside. Now, on the shorter term, we'd like to use as confirmation. We actually, in the last couple of days, that last big rally of almost, I don't know, 700 Dow points or so, worked itself off on the advanced decline to an overbought level where it's now reversing. However, we like to look at up-down volume and, excuse me, that was advanced declines got really rich here. So this particular indicator on the bottom is looking at advanced declines on a shorter term basis. This is a bit got overbought and now has turned down. However, as we noticed that there wasn't really good volume, so it didn't generate a bona fide sell signal as a overbought indication, because we like to look at up-down volume and advanced declines simultaneously. But what it is telling you, as we mentioned before, that the volume has not really participated or been strong on this rally, which indicates overall further weakness. Looking at the calendar range, let's take a look at SPY on the calendar range. And as you can see, this the thick line here, this is the 6-month calendar range. And as we closed under it, we really accelerated to the downside. You had that waterfall crash event. Within 3 days, you lost quite a bit from 205 to 185 or 182 or so. A 10% move just in about 48 hours. So basically, right now, we are set up where we're trading under the 6-month calendar range. That's a negative indication. On the other hand, just looking in September so far, we're trading above the September calendar range. So that is a net positive. Obviously, we want to look at that very critical 194 level, because what that level is important support on the daily charts, and it also coincides with potentially a breakdown of a wedge if we penetrate that area. And again, this is another confirming scenario of a potential sell-off if we get through that 194 level, right? We can draw a let's draw a little trend line here. And as you can see, this red here is the calendar range high, the 1 month or the first day of the month of September. We're trading above it. So far, although we're not really in the clear, because we'd like to at least get back above that 204 level, which is the 6-month calendar range as well. So definitely still the jury is clearly on the negative side here. Momentum, trend, all that stuff has shifted to negative. Let's take a look at the volatility ratio, which is short-term versus long-term volatility. And as you can see, we got really, really extreme. I had even mentioned as we were penetrating the lower end of what would be considered the oversold condition, that once we got beyond the 0.95 level, it indicated more weakness, and boy, did we get that. Now, the interesting thing here is that we are stabilizing a bit here. As you can see, the fear is coming out of the market a bit slowly. So the VIX and the overall ratio between short 1 month and 3 month volatility is showing that a little bit ease of the absolute fear and panic that was in the market, which is to be expected, has now improved quite a bit. And we can see certainly a move back up to that 120 level or so, and that would mean probably the end of whatever the short-term rally is. All right, let's take a look at a couple different assets. Let's take a look at gold, see what that's telling us. Interesting, you can see we got that huge sell-off in July. We're now into a seasonally strong area for gold, where it generally starts to bottom, which it's been doing. So on the panic, did gold act somewhat as a safe haven? It did. It did not continue to make new lows, which is a bit different than some of the other commodities, especially metals. So if you look at copper, you can see copper actually, although it did rebound off the lows, it actually cascaded to new lows as the market was dropping. That's your deflationary pressures. So we have had a decent sized recovery in the copper market, along with the stabilization of the markets in general. So let's see how that plays out. But you cannot argue with the severe downtrend and the bearish phase in copper. This is the daily chart. You can see that the weekly charts here, we're at levels not seen since 2009 and the financial panic during the crisis. All right, so that is looking like gold is stabilizing here. It'll be interesting to see what happens if the Fed does raise. If that does occur, that's going to create more pressure on probably one of the most sensitive assets to higher interest rates. Looking at China, global picture here. China, obviously, huge rally here, huge sell-off. The market went from above 50 to the low 30s. That's a really, that's a 40%, almost 50% sell-off. Not quite, let's say 40%. And clearly the long-term trend on the weekly charts now violated, not looking really good. China definitely under pressure. Let's take a look at the daily chart on China. And as you can see, this was part of the catalyst for the major sell-off. And even with this recovery here, which has been substantial off the lows, but it really hasn't even violated or taken back what I would call a critical support level. And that, again, coincides with its downward sloping 50-day moving average. If we could take that out and basically flatten out this decline here, you might say China's stabilizing, but at this point, we're still under intense pressure and the bear market strongly intact in China. And that is definitely adding to the confusion about what's going to play out with the Federal Reserve. So let's take a look at TLTs, our bond market. And interestingly enough, we're sitting right at now what is a rising 50-day moving average. So this, we've gone from a situation where it looked like the Fed was going to raise, putting pressure on rates. We had this topping action here, moving into a bear market, and then a recovery phase. And the recovery phase right now is still intact. So this definitely gives the bulls in bonds some support. Uh, if we take a look at the longer term trend in bonds, you can see we're still trading above the uh, longer term 200-week moving average. So definitely long-term trend in bonds still intact. We're basically trading in terms of the intermediate term moving average right on it. So you could say that the intermediate or longer term trend in bonds is certainly intact, where there is still some short term pressure. If we step back and take even a bigger look at the picture here, the really, really super long-term picture in bonds is this 80-month moving average. And you can see it's still rising and intact. So this gives support, if you're just purely looking at a long-term trend, to staying with your longer-term bond holdings for now. And the other interesting point is the 23-month moving average, also still intact. So what do we have here? We've got a situation that's fairly straightforward. Long-term trend in bonds intact. Looks like the trend in the S&P and most of the stock indices are being pressured by China. For the first time in a while, we've moved into a negative phase in the U.S. markets, with the exception of NASDAQ, where its longer-term trend is still intact. Let's just take a look at the monthly charts in NASDAQ, and you can see NASDAQ, looking at it on a monthly chart with the key moving average, we actually tested right on the huge sell-off, but managed to close well above its rising 65-week, rising 23-month moving average and the 200. So far, the NASDAQ is still holding up. That is our strongest stock index, probably across the board and across the globe. However, different picture in the spiders. You can see we have broken down on on a monthly chart, right? That 23-month, we have broken down under it. So clearly there's a sea change here, difference between the majority of the U.S. stock indices, which have turned negative, and basically the Qs are keeping the market afloat and hanging in there. So we have to take a look at how the Qs act. That's probably going to be your best lead indication. If we fail from this recent rally, like I had mentioned, that will probably indicate a further waterfall decline in the SPY. Now, turning to Europe, EUO. No, actually, let's take a look at the euro, which is FXE. So one of the stronger asset classes right now is the euro. As you can see, it really got pummeled earlier this year, and it's been recovering, right? As our stock market has gone into a bearish phase, look what's happening here this by the close of business this week. You can see that the currency, the euro, has now traded above the 200-day moving average, held to 50, and it looks like we're going into a accumulation phase. So this is very, very interesting to note. Obviously, a bit more stabilization in Europe versus China. And this is definitely a positive development for the euro. If we take a look at one other thing that is of interest, PCY is emerging market debt, and also what's interesting is you had that big flush uh, as the global stock market sold off last month, but the recovery in emerging market debt was much stronger than the rest of the markets, right? Because we've gone from, uh, well, being in a bearish phase, moving into a recovery phase, and notice how that 50-day moving average, we're trading well above it. Not so in the spiders and a couple of the other key markets that I showed you. So that is of interest as well. The fact that emerging market debt has actually come back much strong after the huge panic sell-off. So that's interesting to know, and might be an indication that we won't get the rate rise that some of the players are thinking. All right, well, that's it for now. Obviously, it looks like it's pretty dicey out there, depending on what the Fed decides to do. Obviously, putting more pressure on the stock market if it does raise rates. On the other hand, if it eases off, it may also be taken as a negative as well. So it's it's hard to see how this is going to play out. I don't think there's any assurance or any short-term clarity. One way you might decide to play it is to essentially wait until the Fed makes its decision and then give it a day or two to settle in and then play it off of the range that was established just prior to and just after the Fed decision. Okay, that's it for now. See you next week. Stay frosty. Cash is not a bad place to be for the moment. Thanks, and see you next week.